Ladies and gentlemen of the crypto space, we're live on a Monday, October 2nd at 11:38 a.m. responding to broken. Responses will occur. Responses occur at the legislative, the regulatory, and the individual level. It is broken. The system is broken. We're going to look at the bond charts, and you'll see that the system, as everyone understood it at the individual level, is certainly broken. And you could always ask the question, did regulators and monetary authorities know that their policy would cause the system to break as it has done over the last couple of years? I don't think we need to answer that. It's an open-ended question. The odds are they're extremely intelligent. The odds are they knew this was going to occur. And they could have their rationale. They could have their intelligent reasoning why it was time to break the system. The odds are they knew that the knock-on effects of the shutdown and what it was doing in China, and maybe it goes back years. Maybe this stuff is pre-planned from like 2018, 2019, and they saw cracks forming, and then you have the whole grand conspiracy theory type directionality to think about, but you don't have to overwhelm yourself with the conspiracy theories because you don't have answers to them. They're fun to entertain, but that's neither here nor there with regard to our individual capacity to make rational decisions. That's just fun. It's interesting. But we don't have to digress too much on conspiracy theories. We have to make rational decisions based on the information that we do have, based on the realities that we have to engage with on a daily basis. And the reality from an individual level is regulators could have made decisions for whatever reason they saw they needed to make a decision, and legislation's going to take forever, and Congress is slow as shit. So we, as the individual, have to make our own decisions based on the news articles, the opinions of other very qualified macro investigators who have access to data that we don't necessarily have access to. So probably, in my mind, the biggest thing we've gotten from other intelligent macro investigators is their theories, their rationale, their narratives, their stories. And that gives us a sense of how things have broken and what are they breaking into? How is the world changing? Even like, Ray Dalio presents very nice stories about how the world is changing, and the list is long of macro persons that have given us great insight into how the world is changing. But aside from the stories, this chart in itself is the world changing in data form. You literally have the 10-year breaking the 100 SMA on the 3-month. Not even the monthly. The 3-month chart, a breakout, a retest, and a higher high. That's crazy. That is significant confluence suggesting directionality invalidation. And directionality invalidation is the lower high and the lower low. In 2020, this was the blow-off bottoms of blow-off bottoms for any chart I've ever seen. When you make a move in the prevailing directionality to such an extent, and then a reversal breaking the prevailing trend, holy shit, that's a blow-off bottom. This is a reversal. This is confluence suggesting continuation of this reversal, the breakout, the retest, and the higher high. That's the trifecta of bullish confluence that we've talked about for all these years. So this basically supports the argument that the Fed makes to a degree. It's not as simple as what they say with that phrase. Higher for longer, rates are going to present themselves in higher lows and higher highs. You can't go back to zero because that has very deterministic effects on consumer price inflation by allowing credit at ridiculously low rates in a post-globalization world will result in excess currency supply in the system, which will place pressures on consumer price inflation. Excess employment rates will keep going up because companies can afford to pay higher and higher because they just finance it with bullshit interest rates. So I see nothing of the system anymore that supports neither the need nor the likelihood of zero interest rate policy. So what I see likely heading forward is the higher lows and the higher highs, and likely lows are going to be 2.5%. So the solutions to GDP and the solutions to disinflationary pressures, and we've had deflation in the current in M0 and M2 have deflated on a year-over-year basis, which is a very rare occurrence. But the solutions to those pressures over the last 10 years since 08, 09, and 010, when they started to kick in with the monetary policy, was monetary policy. The solutions were monetary policy. But in a higher low and higher high interest rate world, the solutions to those pressures aren't monetary policy. They become fiscal policy. And that's, as Luke Gromen and others talk about, the situation being fiscal dominance, where the only way to push the system around is with fiscal policy. So in that world, the equations that we have to consider from an individual actor perspective are quite different than what has occurred over the last decade, the 2010s, the growth narrative. How the hell do they grow? How do these stocks get to where they are? I mean, we're talking about the majority, the aggregate, not necessarily the big players, the Apple, the Microsoft, so on and so forth, the Nvidia. Good credit. And the buybacks, they could issue bonds, and people bought the bonds because they wanted the collateral so they could do whatever the hell they wanted to do with it, or they just borrowed at whatever rate they can get, 0.5%, 0.25%, and their buybacks, and they drove the prices of everything ape shit, because if the company's buying back, the general public, retail, hits the market and front runs the shit out of it. So that's why the stock market has done what it's done over the last decade. I think that narrative is significantly changing. So the way equity markets probably move is the companies that have the massive cash flow, the mega corporations. And this has, precedence throughout history, that this type of environment leads to the concentration of capital and the concentration of corporate structure, corporation, with the largest of actors, because the smallest of actors that need financing, that are exposed to interest rates, have trouble and likely don't survive in aggregate. But the large ones, I mean, Apple, they don't need financing, they got cash. But Berkshire Hathaway, it's cash. They're sitting on hordes of cash. They don't give a shit about credit. And when everything tanks at some point, when you have not just the bankruptcies, the largest bankruptcies in a long time that we currently have, but when you have like literally a tidal wave of bankruptcies, then they come in and they buy everything. So that's what happens when you have this large concentration of corporate structure that has a huge amount of cash flow. And history is littered with this kind of sequence of events. And this means the stock market is going to present itself differently, and maybe it's very consistent with the exponential age that Raoul talks about, where the largest of corporations, the tech companies that print cash from sales, not necessarily collateralized debt positions that we talk about, but they just keep growing and going and going and going because their cash flow keeps increasing, and more products and new products, and they go global, and they have enough cash to literally change the world, technologically speaking. And we have the whole robotics generation coming into picture, which is going to be quite fascinating. And that's a whole set of new products for the entire planet that disrupts all industry. So What does that mean for the entire investment landscape from an equities perspective? That means a washout. It means literally the tidal wave just sweeps away anything that doesn't work, that only worked in a low interest rate environment. And that's what I've been talking about with regard to how do you garner investment. If you're a big corporation, you issue bonds, you sell shares. But if you're small, mid cap, and you're not necessarily even public, how do you raise capital? The only way to raise capital is in a high interest rate environment when you can't borrow it, and your stock, you're not going to have tremendous growth. You're not going to have, doubling revenue and, significant percent increases in revenue. You got to pay people. Why would I buy a company? Why would I buy shares of a company? Why would I want to own part of a company? Because I'm going to get the goddamn cash flow of the company. So that's the world in which we're heading, and that's the world that people are not talking about and they're not prepared for. And you know what's interesting? It's even the dividend investors, what I see on financial Twitter, FT, Financial X, whatever the hell you want to call it. They're not ready for it. They're still talking about the upside, the large upside. And how are you going to get growth? Where's the upside? Where's the borrowing? Where's the debt? I mean, look at my favorite is probably, cream of the crop, Realty Income Corporation. Where's the growth in real estate going to come from? They're not borrowing at these interest rates, so they're not going to be expanding. Their cash flow isn't going to expand. That cash flow is really rock solid because of the way net lease works. I mean, they're pretty much booked out, and all of their properties are just leased to corporations, and so it's very stable and very interesting in that regard. So I don't see any issue with the future of it as an entity, as an enterprise. But I don't see the growth. I don't see where the growth's going to come from. Growth meaning stock price growth. I just don't see it. And if they want to garner investment, they're going to have to adjust the way they pay. Maybe they're going to have to do buyback and burn to undilute the shares and get their damn interest rates up. And that's how you garner investment in this type of world. In a high interest rate world, higher lows, higher highs, you garner investment with damn rates. So, where's that leave us, the individual? If everything's broken, you can't always go to the extreme where it's like post-apocalyptic, everything is going to fall apart, in which case it's like food stores and ammo stores and shit like that and be off the grid with regard to power. But we can't do that if we're living in urban areas or even rural areas near urban areas. You could do that if you're literally off the grid in rural Arkansas. But us in, metropolitan areas, cities, or even near cities, South Florida, and anywhere there's even moderately dense population, unless you have the capital that you could rebuild your entire house, consistent with this narrative of survival and independence and off-grid, it's not necessarily the thing that everyone can do. The vast majority of people that listen to me are certainly not thinking of this. They're thinking about, how do I navigate this market and do a little bit better and do a little bit of investing, and what are the things to look at to actually outperform and to own and to achieve financial goals. And those are the things that are still critical. I don't see us as a society devolving into anarchy. At some point, they always finance social civility. And that means either the Fed is the buyer of last resort, or Treasury becomes the buyer of last resort, and they're able to control the interest rates. And that's what Japan has done for decades now. And that is our destiny at this point. I mean, literally looking at this chart, that is our destiny. If who's the buyer? If everyone's the seller, and they'll have to control consumer price inflation in different ways. So if they can't raise capital by issuing debt because the world isn't buying it and the Fed's buying it, what's the difference? There's no difference between that and printing. So Treasury could print and just literally get rid of the Fed. They could do their own buy. They could print their own currency, buy the bonds from the market. Treasury could do the entire yield curve control. And why do you need the Fed to print the dollar liabilities to buy the bonds from Treasury if Treasury could literally just print dollars by congressional mandate? So in this kind of world where interest rate policy doesn't really have much bite, kind of, you might not necessarily need them. So this is the type of world that can start to get strange. And look, the concentration of power. If the Fed doesn't have much power anymore in a fiscally dominant financial situation, Treasury kind of has all the power. It's the same thing I just described with corporate America, the corporate world. Yeah, it's going to get wild in 2024. I mean, these rates, how the hell are you going to refinance 11.5 to $13 trillion at 5, 6, 7% interest rates? That's Luke Groman's primary argument, and I don't see that being reasonable. They're going to have to get interest rates down, which means they could let them rally to 5, 6, 7%. Look, they'll let them rally to the 200 SMA on the 3-month chart, blows up a shitload of regional banks, and the big banks buy them, they paper over it, and it blows up, large swaths of corporate America. The equities markets start to tank. It might not be S&P 500, the S&P 500, or even, the top tech companies that are pure cash, but it could be the aggregate where the corporations that are zombies, that they can't get credit, especially at 5, 6, 7%, they're gone. So what happens to the investors in the markets, in NASDAQ and S&P? They're liquidating, they're selling, and there you get your aggregate, like you get your RSP type crash, equal weight, rather than an S&P. You get the aggregate, like the Russell 2000 will get hit hard. But the stuff that is not interest rate sensitive remains steadfast to a degree. You'll get capitalization and sell off there as well, but it won't be as bad as the shit that's complete zombies. And where does all that capital go? That capital that's liquidated, yeah, there you go. There's your bond market rally. So you get your equities market crash. The large corporations that are cash heavy do just fine. They survive into the next liquidity cycle. You get your bond market rally to 2.5% on the 10-year on average. So the long end finally is below the Fed funds rate, and the Fed funds rate basically controls the short end. So there you go. There's the inversion of the bond market. The long end rallies, that's global collateral. Long end rallies, that kind of percent, from 5, 6, 7% down to 2.5%. You know what that does to the price of collateral from a global perspective, considering what collateral is used for? There goes the liquidity cycle. So the bond market rally is a leading indicator for the global liquidity conditions. Give it a quarter, 3 months after the bond market rally, and there you go. There goes the buy pressure on the dollar, because why buy dollars if you could print dollars using collateral that has just gone up in price a significant amount? Dollar comes down, bonds rally, and liquidity starts to flood the international system. And to bear in mind, this is the financial economy. This isn't the real economy. Credit's still tight at 2.5%, and you just had a washout in the corporate world. So you get concentration of enterprise, you get the high interest rates are still repressing the capacity for corporate America to grow. The growth narrative starts to fade. The value narrative starts to reemerge because corporations need investment. How do they get it? You got to pay people, which means you're downsizing human resources, you're changing your supply chain, you're cutting back on real estate so you can pay your damn investors so you can actually have investors. Growth turns into value. Crypto, about a dozen to 2 dozen different assets really hit hard next year. The repricing of growth into value, you could easily see the value-oriented crypto assets go some multiples. because they'll express a degree of growth because they're repriced. All the capital has to come out of growth and it has to go somewhere. So, spread. It's like spreading chips around. Where's the malinvestment in growth going to go as it gets liquidated? There's going to be less viable investments in value because most of the value in equity land is bullshit. I mean, nobody's going to buy 6% value. And maybe they'll start to buy it when the long end is at 2.5%, but they're not necessarily going to buy it if the short end is at 6%. They had 5 and change right now. Fed funds is 5.33. So you're not going to buy equity value with Fed paying 5.5% with the short end paying 5.25. It's not happening. So that's why it's interesting in crypto value land, because crypto value land is not paying 5%. It's paying 15, 20, 25% with no human resources, no real estate, no OPEX because it's operated by software. It's about comparable to what's going to start to play out when robotics come into the picture in equities land. As soon as Burger King and McDonald's and Chick-fil-A get rid of all their humans and have complete robotic operation of their retail presence, that changes their financial equation. They no longer have to pay salaries. They no longer have to pay benefits. And their operations become more efficient because with robotics, they're predictable. You can produce X amount of meals on an hourly basis, so now you could service more customers. You might need less of a retail footprint. It might be smaller retail. You could cut the store in half and rebuild it. And so you can see how corporate America is going to change significantly with robotics, and that's the same thing. That's the real economy. So in the financial economy, the same thing occurs because smart contracts don't need humans, don't need real estate, don't need salaries. They just operate deterministically 24 hours a day, 7 days a week. So interestingly enough, what the general public thinks is a large growth opportunity, the appreciation of crypto. The price of crypto goes higher and higher and higher, and to the moon. We're going to make all this money. No! But crypto is the value narrative, literally. That might be the biggest contrarian take of them all about the crypto markets. Crypto is pure value. I mean, obviously not a lot of the shit that most people talk about, but the few crypto protocols, about a dozen to 2 dozen maybe, just throwing out a number, are actually the best representation of a value investment ever presented. An equity cannot achieve what a crypto value enterprise can achieve from an efficiency standpoint, a cash flow, a yield, call it a dividend perspective. And that's freaking crazy. So everything's broken, the whole world is changing, and you don't need to freak out about it. You don't. You need to make good decisions based on the things you can do. Now, most of us aren't building bunkers and going, cutting the cord and going, no power. You're making your own power. Most of us aren't doing that. So this is what we can do. We can understand these financial enterprise from a value perspective and capitalize on the initial growth impulse that these value assets experience as value, as what is traditionally thought of as growth is understood to be a malinvestment, and the redistribution of capital occurs, and the value cycle, which is, arguably this. Maybe this is they talk about this as a secular structure that has been broken. But maybe this really is the growth to value cycle. That's an interesting way to put the bond market, or at least the story that the bond market tells. 4.7% on the 10-year. It just goes up, up, and up. It's disorderly. It's disorderly right now. And years ago, Fed, Congress, Treasury would have stepped in already. The whole structure is broken. Absolutely wild to look at this chart right now. TLT is a shit show. Angelo, ear end, Leandro checking in, Sergio, Austin, Asarco made it live, comfortable, no action to take, feels good. What the hell are we gonna do? I got nothing to do. We got nothing to do. Payday's Thursday. I got a couple of folks on Discord that are contemplating liquidating because the narrative may be changing, but it's a contemplation. It's not like, yeah, it is changing with regard to a particular asset. We're thinking about it, and it's not entirely clear. So nothing is ever black and white. There's endless shades of gray. So even though it's obvious the rotation of capital from growth to value is occurring, it's not so obvious who has the best survivability characteristics, who's presenting the best narrative, the best value narrative from a cash flow perspective, who has really what it takes to outperform in future liquidity cycles, not just appreciate because capital's flooding the crypto markets and has become a positive sum game again, not because of that. What is really going to be that value crypto asset that changes your life? And that's not an easy observation to make. You know when it's an easy observation? From hindsight. That's the only time period where you get answers. When you're looking back and you're like, oh, that's why it did what it did, because it really was something important. Raul, a pleasure. Dan, good morning. Austin, hi. Noah, what is the benefit of owning Convex over VECRV from a vote rental revenue perspective? Was watching your vote rental video you made the other day and was thinking this. In the end, my general opinion right about now is likely not much. For instance, Tetranode sees the end of CVX incentives as big because Curve has incentives that are disinflationary that go for another 100 years. So over that time, Convex, being the critical owner of Curve, is accumulating, and therefore one CVX represents more and more and more CRV over time. So I just speculate, that's just shoot from the hip, that it probably balances out from a vote rental perspective. And that's not necessarily the case, but it would make sense. It's, what it is? It's like looking at a system from two different perspectives. They're going to look different. They sure as hell look different, which is why everyone's like, oh, convex, curve, cleaver, concentrator, union, stake DAO, Yearn, and all the stuff, the Prisma, and endless. And I just mentioned the new one on Discord that's probably coming online. And there's going to be more because it's a business. It's going to become a business to accumulate CRV and accumulate voting power. And there'll be a fight over it, and there'll be more and more and more. And what's the difference between any of them? Likely not much. And that's why I'm like, base layer. I don't have time for this shit because as more and more come online, the base layer is just going to be stronger, and the vote rentals will likely be cyclical as price points change and interest, the percent yield, percent APR changes. It's all going to be cyclical. And that's exactly what we've seen throughout 2022 and 2023. We've seen vote rentals applied to vote market. We've seen the same protocol, then test out Convex, same protocol, then test out Aura. And they're testing, and they're trying to optimize. So what happens is a protocol is wanting to finance liquidity for their own self-benefit, it's a capex, just like advertising is a capex for the health of their business. And it's not like they're going to find, oh, this is the best one, period, and it's not going to change. What's going to happen is, because it makes sense, it's going to cycle from protocol, and the capital will flow throughout as the configurations change. Configurations being relative APR, which is relative to the price point, which is relative to buy and sell pressure, so on and so forth. So my expectation is, Austin, not much. What's nice is the different features. So obviously with base V curve, we're still needing to claim on a weekly basis, but whereas with VLCVX, you have hidden hand. No, I'm sorry. You have the auto claimers, the auto voters, and that's something that's convenient. You could do that with via Aura on hidden hand as well as on the Warden. But you have Vodium for convex, so you could delegate your votes. So that is considerable. Size of the portfolio is a consideration there. It costs money to vote. Gwei just popped up the 41, but I saw it at 8 like yesterday, last night. That was wild. So portfolio size is a major consideration, and it may not be the case, as I say all the time, that this type of strategy for value is warranted. If the portfolio, and that's inversely proportional to the size of the portfolio, as the portfolio becomes smaller and smaller, growth may need to be the path of capital management until an adequately sized portfolio is achieved. And it's going to be subjective what that threshold is, and only each of us individually must define those values. So always think about defining rules, defining price points and thresholds and your portfolio size and how you attack the market with different components of the portfolio, how you structure the portfolio. And only you can make these rules, you being all of us. So I hope that helps. It's not easy, and the time is now because you want to be prepared. You always want to be prepared, whether it's good liquidity or bad liquidity conditions, because the last thing you want to ever find yourself in is a position where you're frantic, where the price action is extremely volatile, and you're like, what am I going to do? Did I buy? Should I have bought? Should I buy next week? It's going to drive you nuts. And I say this from personal experience, and I guarantee you all the veterans listening to me now and on Discord are like, oh shit, I don't ever want to do that again. Price is crashing. Should I buy? Price is boom. Yeah, you don't want to be frantic. The path to success is a path that's comfortable and like, oh, that's cool. So that's the most important thing. That's the most important goal to achieve is comfort. Because that's why we're doing this. We're doing this so we can attain comfort with regard to the way we operate in the real world using this financial economy. Hey, Cap, when we're talking about the long end rallying, would that be the price of, say, 30-year? Yeah, 30-year definitely. And it was 2 years and higher, more or less, maybe even the 1 year. But most of it is 10-year, like 10 to 30. That's big stuff. Like most talk about the 10-year as pricing interest rates to a degree. I think that's common practice. So the 10-year is critical to really assess what the hell is going on. But anything long end is collateral. Short end is Fed funds rate and monetary policy and what banks use. Banks use the short end. The investment world uses the long end. So the dollar world uses the long end to print dollars. So when the Ave health factor of the planet pops up 20, 30%, what do folks do on Ave? They borrow. And that's when you're talking about the amount of collateral that's in the system and the amount of leverage that's used to print dollars from a financial economy, a global financial economy perspective, you're talking trillions. And it just floods the system. So in an interest rate, a higher low and a higher high interest rate world, you're going to have to realize that that flooding of the system with liquidity is going to have a different investment profile than a zero interest rate world. Malinvestment is going to be cured to a great extent. The growth isn't going to be there the same way. There'll still be growth. You'll still get outperformance, especially in crypto markets. So you still have opportunities as a relatively small portfolio to experience those large asymmetric returns, but it's going to be different. It's not going to be the same. Malinvestment will be cured to a great extent in a higher low interest rate world. And I'm very excited about that. I'm tired of bullshit memes and bullshit malinvestment, like the whole meme stock and GameStop and AMC. That's fucking ridiculous. It's stupid. This is not a game. This isn't a game. This is finding comfort and peace of mind in life, which is crazy. Items in the house. The cap. In my opinion, the safest crypto bets for the upcoming years are on ETH, Link, Curve. There's a list. It's to me, a lot of folks continue to argue that in the new emergent crypto cycle, the biggest winners are the new stuff. The new stuff will still experience the growth narrative, which is, asymmetric returns and PVP, buy side pressure, price goes up significantly and then it dumps, and, the same shit that always occurs will occur again. But I think the core systemically significant protocols are very different, especially in 2024 compared to 2018 and 2019. So obviously, when I say 2024, it's years since 2018 and 2019, and you really have to consider those years in particular, because post 16 and 17, nothing survived. A couple survived. A half dozen. I mean, literally a half dozen significant protocols. Maybe a dozen if I stretch it. But there was no economy. There was no financial markets. There was no financial economy as definable in terms of an emerging market where there's dollar liability capture and dollar liability printing. It didn't exist. So everything post 2020, like end of 2019, is not the same crypto space as definable in historic terms between 08, 09 and literally a decade. It's not the same thing. That's different. It is different. And it wasn't different over 22 and 23 with regard to price action. The volatility is still there. That's that's fine that's not different. But this is a world where 60, 70 billion dollars have been captured on mainnet, and over 100 and something, I think 120 billion dollars is still up on the overall crypto space. If you go to all, we're still at $124 billion worth of liquidity, dollar liabilities. That's what counts. That's all the money. I don't give a shit about total market cap. I don't care about 2 trill. I care about what you could sell this shit for. Because this is what counts, because this is how you buy egg sandwiches with actual dollars. And there's little to no difference between dollar liabilities, because you could convert a dollar liability into a dollar to facilitate settlement. So $66 billion worth of capturable dollar liabilities on Ethereum mainnet. You know how much there was in 2019? Basically zero. It's like 12 million, I think, in a post, an X post that I did a little bit ago. It's like 12 million bucks on Uniswap V1. I wish I could hold on to, pin that tweet. It was a really good tweet. As for, we don't need to digress or dig into each protocol. They each have their own story. Agree with the cap that Link has to prove cash flow. Yeah, well, frankly, you just answered probably what I was thinking about. Has to prove cash flow. I mean, clearly, it is unquestionable at this point that Link working with Swift and doing whatever the hell they're doing with the BIS and World Banks and all the CBDCs that are endless, that's crazy. It's big tech. But in the end, how much is it going to fucking pay me? If it's going to pay me nothing, I don't care because the world is changing. Rewind to the entire beginning of the stream of growth versus value. And yeah, Link could go up 100x on the money, but that's growth narrative. That means you're sitting, watching the technicals, trying to capitalize and sell, dump on other players in the whole biological predator-prey story to capitalize, and that requires work. And I don't want to do the work. I'd rather have a value play that goes up 5x, 10x on the money. That's paying me. Cash flow. Click a couple buttons on a weekly basis. That's comfort. That's winning. Not having to sell and figure out when the best time to sell is. Drives me freaking nuts. Yet it feels like it's Monopoly to me. This is all Monopoly. Why? Because that's a game based on capitalism, and this is all a game. Money is a means of organizing labor and incentivizing civility, and also, rationing natural resources. So money is very much a game, just as any video game you've ever played. Period. It's just the big boy game that most people don't even realize they're playing. And that's the whole red pill, blue pill argument and why the Matrix is so relevant as a story. CVX should be added to my classic list there probably. CVX, surely. Everyone has to write their own list, and you have to listen to other people's stories and define what attributes you're looking for, what the composition of your portfolio should be based on what you want to do. Maybe you want the growth, and maybe you want to put in the work, and you want to understand technical analysis, and you want to capitalize 10x, and then get another 10x. And it means you have to really know your damn technicals. So you're looking for your patterns and your trends, and frankly, you're probably waiting for up-only modes, and you're looking for ascending triangles, and you call it a day, which means patience. We'll be doing our capital gains at some point. Everyone knows that that one, it's destiny. Two, if there's an opportunity, we're going to take it. But this time around, especially for myself, it's going to be, oh yeah, buy and wait and then sell. It's going to be slow as shit, boring, and a whole lot of patience, because we're going to wait for a damn ascending triangle. It's going to find support. We're going to wait for the proper conditions, such as 3 tests of resistance. It's going to break out, and we're going to get rid of it. Pure capital gains, PvP, predator prey, but we're only going to do it when it's like, oh, that's obvious. We're not going to force it, and we're not going to put in the work. Thanks, Cap. Very rational. You're very welcome. Brady's in the house. Barry. Hi, Noah. Don't you miss your DGB times? Digi. We had fun writing that Android wallet. Different times. I was 16, 17, and then 18, 19, I played around with some stuff, wrote some code. Different world, different time. Now we have 60-something billion dollars of value capture in an emerging market. It's a very different narrative than, self-sovereign money, and that's meaningful to a degree because I'm a big talker of eliminating counterparty risk, or at least having capital that is, not confiscatable other than by force, and the bank counterparty risk. I've had some bank experiences over the last year or two that remind me that it's worthwhile to pay a premium to not have exposure to a bank. It's a premium paid in either risk or volatility, which is kind of, synonymous. That's part of the equation. It's part of the entire story we tell. But the most important thing to always remember is, like Digibyte, and Bitcoin, they all have an inflation rate, which means for their price to appreciate, there needs to be buy-side pressure greater than the inflation rate, and that's just to prevent it from depreciating. Also important is they're inflationary. Like everyone always says, Bitcoin's not inflation. It's fucking inflationary. Bitcoin has a 1.7% inflation rate, and the halving is going to drop it down significantly. But bear in mind that's still cyclical. Every couple of years, every 4 years. So it's disinflationary every 4 years, and in between, it's literally an inflationary system. And I define pretty much all those assets, Litecoin, Bitcoin, so on and so forth, even Ethereum, Digibyte, these are all FX. These are all currencies. And these currencies have different properties, just like the yen, the pound, the dollar. There's either inflationary pressure, disinflationary pressures, deflationary pressures, and FX is a liquid market. And it's capable of being used for settlement if there's liquidity. Like you could literally pay for things using any of those assets, currencies, cryptocurrencies, because they're liquid with dollar liabilities. And you get them into a debit card, you get them into a bank account, and you can pay with the debit card or so on and so forth. So you can use them for settlement, but you have intermediaries. So they're not exactly where everyone wants them to be, where you can make a direct payment with them. But I don't think that's necessarily a world that we should be expecting anytime soon. So the world that is currently the world that we currently have is a liquid FX market where you can execute settlement using Bitcoin, Ethereum, so on and so forth, but you have intermediary steps. So the solutions are going to be making those intermediary steps transparent, where you make a payment and it automatically processes the settlement in dollar liability form, or frankly, whatever FX instrument, currency that the retailer wants to accept for payment. Everything's going to be liquid. That's the world we're heading, and that's why we talk about AMMs. That's why we talk about these DEXs, because they facilitate the liquidity to allow for settlement in any denomination and payment in any denomination. And that's a crazy world, because you can't own FX in traditional finance, but you can own a piece of FX in the crypto market. So yes, Barry, indeed, very much. It's been an interesting ride to get to where we are. Something you mentioned about taking gas fees into consideration. How much is gas when voting for VE curve? I don't know. I think it depends on Gwei, obviously. So it's 10, 20, 30, 40 bucks a vote. There we get into high Gwei times, and then you got to relock as well. So it is a consideration. There's some places to look to minimize gas expenditure. VLCVX, and then you just you delegate on the warden, and then you're just claiming USDC weekly. Bi-weekly. That's a consideration. Now, it's not necessarily always, everyone has to make their own bed. We all make our own decisions. We all compose our portfolios the way we see fit. And the most important thing is expectations. Don't exceed your expectations. Listen, 20-25% is going to be frickin' disappointing for someone with a $5,000 portfolio that is looking to make a lot of money. $5,000, 25%, you're talking about $1,250 or so a year. So you're talking your claim is going to be $1,250 divided by 12, divided by 24 bi-weekly payments. It's going to be relatively small, $50, $100. So expectations are the most important thing to get right. Don't be disappointed. Don't find yourself disappointed. Appreciate your ability to jump from topic to topic and explain each one on a high level and very effective. It's been a heck of a ride getting to being able to tell this kind of story. Thank you. I appreciate it. Means you've internalized a lot of these concepts. Appreciate your brain. I will be here through the bear market, through the bull market. We're going to have a lot of fun because the bull market, when it comes, it's inevitable. It's going to be calm. We're going to be doing this. I got my feet up and we're talking. We're not going to be frantic. We're not going to be hyping things. We're not going to be to the moon bullshit. I don't have time for that stupid kid shit anymore. TikTok and BitBoy and whoever the hell is the popular shiller. We are the anti-shill community. James, Unibot, any interesting model of capturing Uniswap volume? Yeah, Bunny. That's about it. Bunny has the same complexity as Aura, really. Lack of sterilizers and recycling systems. So they're speculative. But Uniswap obviously will benefit significantly from an incentive and recycling regime. Whether the pieces come together to make Bunny as sustainable as I want it or hope it to be is another story. That's a 1% to 10% type thought. For me, not Uniswap. I know a lot of folks depreciated. There's a large rotation of capital, but I have my exposure to Nolo, which is the Discord trading bot. I don't know. It is what it is. That thing has depreciated significantly, but I'm still above entry, but it hasn't materialized. The cash flow has been very nice to see, but it's not. There's a difference between like growing infrastructure, a growing federation, and speculative cash flow. There's a difference between something that's entrenched and you just see time and time again a new actor come into the space, a new protocol. And it's like, oh, yeah, we expected that. Just another recycler, another sterilizer versus something that still hasn't gotten that momentum. You lost your awards if you don't claim weekly for CVX. No, CVX CRV compounds on Convex's website, but for VECRV voting, whether no, it does accumulate on Warden, but on Vote Market on a weekly basis, you got to claim weekly for VECRV. But you're talking CVX CRV, that just grows and grows and grows. That's convex. Yeah, Dan's asking the right question there. Can Warden accumulate CVX rewards in USDC the exact same way it does for Aura? I believe they accumulate. So CVX gets delegated as VLCVX, and it's just, it gets added to the claims list. So I believe that does achieve what you're describing with it all being automated. I myself have VL Aura and VLCVX delegated on the Warden. I don't care if I could optimally vote manually anymore. I'm just like, I just want to claim weekly and achieve that comfort. And as we've said time and time again, I will pay a premium so I could do less work and be more comfortable. What's the fee on Warden? Whatever the fee is on Warden, it's less than Hidden Hand. That's all I need to know. Probably comparable to what VL Aura is. Less than Hidden Hand. So Bitcoin had a nice rally up to 28,000. Ethereum as well. Ethereum's doing a nice retrace, 2.5%, down to 1689. But what I like to look at is Ethereum denominated in Bitcoin. And clearly Ethereum's depreciated significantly against Bitcoin, and that is inarguable, so Ben gets it right. But look at the time-weighted average price. So what do we say about time-weighted average price on many charts? Anytime you're above the time-weighted average price on not necessarily the monthly, but certainly the 3-month and the 6-month, the buying opportunity is below the time-weighted average price. And you may not get it, but history says a couple of things here. One, this is a very different period in Ethereum's history compared to Bitcoin. This is obviously pre-merge, pre-burn, pre-emerging market narrative. So maybe there isn't so much history that says this is super significant. Can you get to such a depreciated price considering the prevailing narratives right now are starkly different compared to 18 and 19? Different world back then, even in macro financial land. So I don't think you could expect, that kind of deviation to the downside from the time weighted average price, 0.45 to 0.17, that's 60%. So I don't think that's reasonable, and that's why this trend is so interesting. I mean, maybe you get a little divergence to the downside and you're down at 0.053. So below the time weighted average price and is the buy, and anything above it is a premium. And if you look at even Bitcoin on the 3-month chart, what I like to do is turn off, sorry, there we go. I like to turn off the price point. So on the 3-month chart, anything below, 30, 26, 20, these are good entries. Why? Look at the chart. On average, a buy below this time weighted average price in 3 months, you made a good buy. It will appreciate, it will mean regress to the time weighted average price. A buy above it means you're paying a premium, and it's likely to mean regress to the downside. And that's exactly what we see here. You bought at 68, you have the mean regression back down to the time weighted average price. And that's exactly why, looking at the average prices, you peer through the bullshit. Do not buy it when it's deviated to the upside. Wait cyclically for global liquidity conditions to crash down, and you'll be able to purchase below the average price. And then the mean regression occurs to the upside rather than the mean regression occurring to the downside. Same exact thing is the case on Ethereum. And this is going to be an interesting trend wherever the chart is. I lost the chart. There it is. This is going to be an interesting trend. It's a massive symmetrical triangle. And clearly Ethereum has negative inflation since the burn. And Bitcoin has a 1.7% inflation rate. So from an FX perspective, there is a significantly different supply dynamic in play for Ethereum versus Bitcoin literally right now, especially, most importantly, heading into the next positive sum game, positive liquidity part of the cycle. Hidden hand fees are too damn high. Very appropriate metaphor. Move came down a little bit back to 113. It bumped to 120, but this is still in a precarious situation. I don't necessarily see a resolution to liquidity issues in the short term. I see more likely than less disruption to liquidity. So, Michael Gayed's like liquidity event, credit event, which is a liquidity event. And we see that kind of capital rotation. Broad equities, RSP crash down, maybe concentrate further into the dominant tech equities, and we start to see liquidity flood into the long end of the bond market, and we start to see, 10-year rally to 2.5%, and that's really the start. That is the forward-looking indicator for improving liquidity conditions when the long end rallies. And then in a quarter or so, then you got the improving liquidity conditions. So that's where we are. Watch oil. Oil comes down. That'll relieve some pressure. Start to see it head towards 85. You start to see pressure come off the DXY. I mean, holy shit. Wow, if this thing breaks 107, I mean, this is a disorderly currency market. That's crazy. I can't believe it's up to like 109. I mean, we were looking at it this morning at 106.5 in the open. Holy shit. 106.2. It's up 729 points today. Holy crap. Okay, strap in, boys and girls. This is going to be your bumpy ride, and this is your captain speaking. On a Monday, October 2nd, 12:37 p.m., I appreciate everyone sticking around to the end. 19 people made it to the end. 9 likes. Please press that thumbs up button. I'd appreciate it. Tell everyone to subscribe. In the description, link to Discord, the most rational community in the entire crypto space. I appreciate everyone in there. I will see you again later this week.